Was there anything the Fed chairman said that caused you to change your macro bullish view longer term?
No, there wasn't anything that the Fed chair said that caused us to change our macro view. I mean, the reality is we're in a good economic backdrop. I know that there's a lot of concern that investors have been having about inflation and inflationary pressures that was going to hasten Fed tightening. I think the Fed's been very transparent about allowing this to play out over time. I think the Fed believes, as I do, that nothing structural has really changed. You've got a moment in time in which there's a lot of demand hitting the market, in which businesses had spent a lot of time cutting workers and cutting inventory, and now we've got to rebuild. And so that leads to short-term inflationary pressures. But if nothing structural has changed, you should expect those pressures to moderate over the next couple of years.
And as your own data shows, coming off of recessions, the market kind of allows for greater valuation. Some people will say, well, the market's overvalued based on the forward price to earnings. But coming out of slowdowns, your data suggests that the market may give higher valuations a pass.
Well, it tends to happen, obviously, as the market moves first. So if you think of a price-earnings ratio, the denominator takes time. And, so the market forecasts the better economic backdrop and a better earnings environment a year ahead. And then you start to wait to see, does the economy and earnings deliver? And certainly it started to. And earnings are likely to boom here. It's a very good economic backdrop. Businesses have been running largely lean, so you should see a very good earnings environment. What we've found is, 1 year after a recession, elevated valuations, and then as companies start to grow into those multiples, you can see very good equity returns, even as multiples are flat or in many instances come down in years 2 and 3 of a market cycle. So I advise people to not be overly concerned about valuations. Valuations are not timing tools. And again, companies tend to start growing into those multiples by years 2 or 3 of a market cycle.
And there's so much cash still sitting on the sidelines. Kind of amazing, despite negative real returns, how much money have gone into bonds really in the last decade or so. We like to sound smart here on CNBC, Brian, and come up with all these fancy reasons why stocks go up, but really they go up when there's more buying pressure than selling pressure. And you think a lot of that cash, $20 trillion by some accounts, may end up going into equities.
Yeah, a lot of people worry that cash is going to go into goods and lead to goods price inflation. I think we start to shift away from goods to experiences, allowing businesses to rebuild inventories. But we also allocate that money into markets. As we know, there's been over $1 trillion into money market strategies, over $3 trillion into bond strategies. In many instances, that's not going to get us towards our investing goals in most instances. So that money is likely to find its way more into the equity markets. Equity markets have not been overly popular with investors since the '08 financial crisis, which is surprising given the extent of the gains. So investors aren't euphoric. There's a lot of money on the sidelines. That tends to be good indicators for markets. When I start to get concerned is when investors are overly euphoric, and clearly that is not the case right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.